5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to this episode of the Follow the Money podcast, a podcast where we cut through the noise, follow the trends, and focus on what investors actually need to know. My name is Jerry Robinson, and today we've got a lot to cover. America's national debt is now sitting right on the doorstep of $40 trillion. At the same time, we're seeing long-term bond yields surging, not only here in the United States, but also around the world. We've seen a 10-year Treasury auction clear its highest yield in 19 years. A 30-year Treasury auction just cleared its highest yield in 25 years. And now the Treasury Department is doubling the size of certain long-term debt buyback operations. So the question I'm asking today is pretty simple. Is the bond market beginning to send Washington a warning? And if it is, what could higher long-term rates mean for your mortgage and for your investments, the stock market, corporate profits, and ultimately the broader economy? We're going to dig into all of that in our first segment today. Then in segment 2, we're going to get into our market insights. We'll leave Washington behind and go right to the markets. The S&P 500 remains near record highs. Corporate profit margins just hit a new record. But market breadth is getting a little stretched, with roughly about 74% of S&P 500 stocks trading above their 200-day moving average. So in segment 2, we're going to talk about why I've been taking a little more profit lately as we head toward the month of September. We'll also check in on the US dollar, gold, oil, copper, Bitcoin, and Ethereum. By the way, copper is hitting record highs lately, and gold is starting to get technically interesting again. And I'm watching Bitcoin and Ether very closely as we move toward what I think could become a stronger part of the historical crypto cycle by the month of October. So we got a packed show today. Let's get right into it. This is episode number 516 of the Follow the Money podcast, which is entitled The $40 Trillion Warning. Let's get started. All right, friends, so America's national debt is now sitting right at the doorstep of $40 trillion. $40 trillion. You know, I know I've been talking about the national debt for years. I've been talking about it for well over a decade. $30 trillion sounded impossible. I remember storming across stages talking about the $7 trillion national debt or the $15 trillion. $30 trillion just seems so impossible. And then 35 trillion and then 37 trillion. We're now literally staring at $40 trillion in federal debt. And as crazy as that number is, it is a very concerning number. I'm a little more concerned about the interest rate because $40 trillion is the amount we owe. Obviously, that's ridiculous. But the interest rate is really what tells us what it actually costs to carry such an enormous debt. And right now, the bond market is, I think, sending a signal to Washington, and it's a pretty uncomfortable message. You know, the U.S. can still borrow money. There are still plenty of buyers for Treasury securities. It's not like there's been some sort of buyer's strike where nobody shows up at the Treasury auctions, but increasingly, those buyers are saying, if you want my money, you're going to have to pay me more for it. In fact, we had 2 Treasury auctions recently that caught my attention. The recent 10-year Treasury note auction cleared at a yield of 4.683%. That was the highest 10-year auction yield in 19 years. Then the Treasury came back to the market with 30-year bonds. Those cleared at 5.216%. That's the highest auction yield that the government has had to offer on the 30-year Treasury in 25 years. So think about what we're saying here. The federal government goes to the market and says essentially, who wants to loan us money for the next 10 years? Or who wants to loan us money for the next 30 years? And the investors were there. They responded, sure, but this is what you're going to have to pay us, right? Now, let me be clear with the language here. These auctions didn't fail. I mean, people showed up, right? The bonds were sold. there's still an enormous demand for U.S. government debt, believe it or not. So I'm not going to sit here and tell you that nobody wants treasuries anymore. That would be absurd. That's not what the evidence suggests. What the evidence is saying is that the price of that money is changing. See, America can find lenders, but those lenders increasingly want to be compensated for tying up their money for 10, 20, 30 years with a spendthrift government like we have in Washington. And when you're carrying nearly $40 trillion in debt, the difference between cheap money and expensive money becomes enormous, especially as it compounds over time. Now, by the way, this isn't just happening in isolation here in the United States. We're seeing pressure across global bond markets. Long-term yields have been moving sharply higher in the U.S. for some time. We've seen long yields hit major highs in Germany. We've seen extraordinary moves in Japan. Japan's bond market, which spent years living in a world of practically non-existent interest rates, has been going through a major repricing of its own. So all of this is larger than Washington's problem. See, governments around the world have accumulated enormous amounts of debt during the era when money was very, very cheap. And now investors are looking at inflation, they're looking at government spending and all the deficits and the geopolitical risk that they're taking on, and all of this new supply of bonds coming into the market, and they're just asking for more compensation to hold long-term debt. Makes total sense. So what we're living through right now is kind of what happens when you have a world that's built around cheap money, but then it starts to have to refinance itself at higher interest rates. I mean, many of us remember for years that investors kind of got trained to believe that 1, 2, maybe 3% was kind of a normal interest rate, but that was not normal historically, right? That was obviously very abnormal, and it became normal to us because it lasted so long. But now let's come back to the U.S. in our minds here, because we're basically at $40 trillion in national debt. We've been adding trillions of dollars to the gross debt in such a remarkably short period of time. So the underlying fiscal picture for Washington is not getting better whatsoever. In fact, through the month of July, the federal deficit for this fiscal year has already reached about $1.8 trillion. That's exceeding the deficit for the entire previous fiscal year with 2 months still left to go. So we are borrowing enormous amounts of money. We have to refinance enormous amounts of old debt as it slowly matures. And so the Treasury continually has to come back to this market again and again and again, which brings us to a question I think investors should be asking, namely, at what interest rate will the world continue financing America's debts and deficits? I'm not asking whether they'll buy. I'm sure they will. But the question is, at what price will they buy? That's the difference. That's what I'm talking about. And this is where we want to think about foreign treasury demand, because there's something interesting happening there as well. Japan and China and Europe and sovereign wealth funds and central banks and foreign institutions. For decades, all this foreign capital has been an important source of demand for treasury securities here in the U.S. But as of late, we've begun to see some of America's biggest foreign creditors start to slow down their purchases of treasuries and actually are becoming sellers. Foreign holdings, for example, of U.S. treasuries fell to $9.3 trillion in June, down from the month of May. And in fact, Japan, which is America's largest foreign creditor, reduced its holdings by around $26 billion during the month of June. Meanwhile, China has cut its treasury holdings down by about 13% from a year ago. And if you've been paying attention to the China story, of course, China is kind of interesting here. Beijing's been slowly and gradually reducing its treasury exposure and then simultaneously building its own gold reserves. Now, I don't buy into the simplistic idea that China wakes up one morning and decides to dump all of its treasuries and destroy the United States. I mean, that would create plenty of problems for China in that scenario. So I don't think that they would shoot themselves in the foot that way. All that foreign buyers have to do is just become a little less eager, like we think we're starting to see. And this, of course, would require a little more yield, right, to coax them into buying more treasuries, because otherwise they might find other attractive opportunities somewhere else. So as long as the Treasury keeps supplying this debt, and if marginal demand continues to weaken, then the market is going to have to offer a higher yield, right, to attract the next buyer. I mean, Washington needs buyers, right? So there may just need to be a gradual repricing of what investors demand in return for financing Washington. And I think that's what we're seeing here. Now, if you're listening to all of this and thinking, Jerry, I don't own any Treasury bonds. What do I care about the 30-year auction yielded? Well, the Treasury market really sits underneath much of the financial system. I mean, when long-term Treasury yields rise, the effects do not simply stay inside the bond market. They spread. Let's think about mortgages, for example. Mortgage rates do not move perfectly one for one with the 10-year Treasury. But longer-term Treasury yields are one of the major forces that lead to mortgage pricing. So if long rates stay elevated like they currently are, and if they continue rising as they have been, then buying a house is going to become even more expensive, right? Monthly payments are going to go up and refinancing is going to become less attractive, which is going to make housing affordability even worse than it already is. Or think about businesses, right? Companies borrow money too, not just the government. They refinance bonds, they finance equipment, they got to build factories, they're trying to buy out their competitors. Many of these companies are building massive data centers right now. So when those rates go up, corporations have to pay more as well, right? And so if you're a strong company, you're a massive company with a big fortress balance sheet, maybe that's manageable for you. But if you got a heavily indebted company that needs to refinance a mountain of debt, you got a completely different situation. So higher borrowing costs can mean fewer projects, less expansion, which means you're going to have some pressure on hiring. You're going to have pressure on corporate margins, which eventually could hurt the earnings. And then that leads us, of course, to stocks, because if Treasury securities are paying investors 5% or more at the long end, suddenly stocks have a lot more competition for capital. I mean, many investors are looking at 5.5% interest rates and thinking to themselves, why should I accept all of the uncertainty in the equity markets when I can just earn, 5% or so from the U.S. Treasury? Now, I'm not saying that's going to cause everybody to sell their stocks and end the bull market, but I mean, that all makes sense. And this is really something for growth investors to think about. Those companies that are high growth, who their valuations really depend heavily upon earnings that are many years out into the future, those can be particularly sensitive to rising long-term rates. So as a growth investor, I've got an eye on this. And then, of course, there's the federal government itself, right? We've talked about businesses, we've talked about mortgage rates and stocks, but what about the federal government? Remember that old low-rate Treasury debt that's already been sold? That doesn't all reset tomorrow morning. It's going to mature over time. But if the Treasury has to keep refinancing old debt in a world of 4, 5, 6% interest rates, then the federal interest bill is going to keep climbing. I mean, U.S. interest payments already right now in 2026 are at around 3.3% of GDP, which is the highest level in this nation's history. So as Washington just continues to deficit spend, it creates more debt. Obviously, that means more borrowing. And then with higher interest rates, you get a higher interest expense. That, of course, creates a feedback loop where you get larger deficits because of the cost of money, and then more debt issuance, and potentially even more pressure on yields. Now, I'm not telling you that that vicious cycle is guaranteed. I'm just telling you that that's the cycle that I'm watching. I'm watching for this cycle. Compare it to a homeowner who maybe took out a huge adjustable rate loan whenever money was cheap, right? I mean, the size of that loan was always there. It was always the same amount, but you really begin to feel it when the financing cost resets higher. And that's what's happening to the Treasury as they roll over old debt and it matures. Now, I'm recording this on the 19th of August in 2026, and this morning we got a fascinating development. So the Treasury Department, which is seeing all these rising yields, right, and is trying to do something about it, announced it's going to at least double the size of certain buyback operations for longer-term Treasury securities. The current maximum is $2 billion per operation, but beginning September 9th, the Treasury said that those operations on those long bonds was going to increase to $4 billion per operation. And this trick seemed to work because long-term yields dropped fairly significantly after the announcement. But you need to know something about the terminology here because it can really fool you. When you think about the Treasury calling this a debt buyback, that does not mean that the United States is paying down any national debt. So they love to use these phrases that sound like they're fiscally wise stewards. In reality, that's not what's happening. Let me say this again. They are not reducing the debt by doing debt buybacks, right? They're still running massive deficits in Washington. What the Treasury can do is it can buy older securities back out of the secondary market while simultaneously issuing enormous amounts of new debt to finance the government. So what they're doing is they're buying back some old bonds and issuing new ones as a way to maintain market liquidity and manage the debt. So they're not reducing any debt. They're simply rearranging some of the debt. They're definitely not eliminating any of America's $40 trillion debt burden. And I think that's an important distinction because I'm sure somebody is going to see that headline and it says, the Treasury is doubling debt buybacks. And they're going to think, oh, great, their Treasury's finally buying back its debt. Well, that's not what's happening. They're not buying back the debt and getting rid of it. They're simply rearranging the way that it is structured. Now, the Treasury says the purpose is to provide greater liquidity support in these longer dated bonds. Fair enough. But just look at the timing, right? We just watched the 30-year yield surge above 5.3% in the secondary market, which we saw it reach levels it hasn't reached since 2007. And then we just watched those 10-year and 30-year auctions clear at yields we hadn't seen in 19 and 25 years. And now the Treasury announces these larger long-end buybacks. So I'm not calling this quantitative easing. I mean, obviously the Treasury Department is not the Federal Reserve, but these buybacks are not the same thing as the Fed creating reserves and then launching monetary stimulus. But the fact that they're doing this and announcing it and trying to get the market's attention with it tells you that they see that there's a liquidity issue here. They know that there are some tough conditions at the long end of the Treasury curve. And apparently the market was waiting for something like this because yields immediately move lower after the announcement. And there's one more misconception I want to clear up too about this topic, because I want our listeners to be informed when it comes to this kind of stuff, because the government they really engage in a lot of shenanigans when it comes to the economy. But when people hear, the term interest rates, they usually immediately think, if they know anything about, the economy, they tend to think, well, that must have to do with the Federal Reserve, right? The Federal Reserve has tremendous influence over short-term interest rates. But the Fed does not simply announce what the 10-year Treasury will yield tomorrow. It doesn't control what the 30-year Treasury is going to yield, right? Those longer-term yields are set by the market. They're set by investors. And investors use all kinds of factors to decide what those rates are going to be. They look at inflation expectations. They look at economic growth expectations. They look at the federal deficit, which is out of control. They look at the supply of treasuries, right? And it's also a matter of current risk appetite. So it's entirely possible for the Fed to eventually cut short-term interest rate targets while the long end remains stubbornly high, right? That would create a very interesting environment for investors. Now, as I record this broadcast, the minutes from the Fed's July meeting are scheduled to be released later in the day, so I don't have access to those. But what I'll be looking closely at when those minutes come out is I want to see what they're talking about in terms of inflation and the current financial conditions, and really that debate of what's going on inside the committee. But let me just talk about where all this leaves us, because I'm watching five things that I'm watching right now based upon what we're seeing. Number one, I'm watching the 10-year Treasury yield. It's an extremely important figure for investors and economists and everything. It's a very important number. Even if you're not an American, the 10-year Treasury yield can really impact even global finance. That's the first thing I'm watching. I'm also watching the 30-year Treasury yield. I'm going to continue to watch the results of upcoming Treasury auctions. I want to see if we continue to see this trend of buyers demanding higher rates. I'm also watching the foreign and institutional buyers of treasuries because I want to see if that continues to decline month over month. And then obviously for investors, probably the most important thing is I'm watching whether the stress in the bond market begins to spill more aggressively into the stock market and the credit market, right? And I've been an investor for quite some time. So the national debt reaching 40 trillion does not tell me to dump my stocks, right? That's not even close to the kind of idea that I'm getting from seeing a $40 trillion national debt. A 5% 30-year yield doesn't tell me to run for the hills. In fact, that's kind of a normal rate. That's not even that weird or unusual. In fact, that's very common in history. Yeah, I don't invest that way. Instead, I want evidence. I want to see what price is doing. I want to see whether credit conditions are beginning to crack. I want to see whether the leadership in the stock market is beginning to deteriorate. And I want to see whether these higher yields are actually producing financial stress across the board. And that's why we're going to go to the charts in our next segment when we get into market insights. But I want you to keep this thought in the back of your mind as we move into the next segment, is that $40 trillion, that makes a great headline, right? But the interest rate is what can really, really turn the screws. It can really make it hurt. And right now, the bond market is telling Washington that cheap money can no longer be taken for granted. All right, when we come back, we're going to dive into the latest market conditions, and I'll share my latest insights. Stay tuned.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back. So one of the longest running personal finance podcasts anywhere. You're listening to Follow the Money with Jerry Robinson. You can find us online at followthemoney.com. Hope you're enjoying the show. All right, well, let's continue on now in segment 2. This is where we focus on market insights, right? We're going to leave most of the headlines behind here for a few minutes. We're going to listen to the markets themselves. We're going to begin with the S&P 500. The S&P 500 right now remains in a big uptrend. We're still trading near record highs. We're above all the major moving averages, and the trend is clearly bullish. And if you look underneath the hood, you're going to find out that the S&P 500 companies just posted a record net profit margin of 16.9% in the second quarter, which is an extraordinary number. I mean, that's a record level. We have never seen profit margins at that level in corporate America. So they're making tons of money. And that's really one of the reasons why this market has been able to absorb so much bad news over the last couple of years. Many people have looked at this market and said, how in the world can it keep climbing? Well, these companies are making money, right? We've been dealing with high interest rates. We've been dealing with geopolitical turmoil out the wazoo. We've had tariff uncertainty. We've had concerns about the national debt. We've had recession predictions seemingly every few months. And yet corporate profits have continued to grow, with profit margins now sitting at record levels. So if you're talking about fundamentals, from a fundamental standpoint, there's still a lot of strength underneath this market. But now when I look beneath the surface at the market breadth, I'm beginning to see a market that's getting fairly stretched, right? So at last check, about 74% of the stocks in the S&P 500 were trading above their 200-day moving average. Now that's bullish. I want to make that very clear. But almost 3/4 of the stocks in the S&P 500 are above their long-term trend line. So that means that we have broad participation in the stock market, right? That's generally what you want to see in a healthy bull market, where the bull market broadens out beyond just a few sectors. But longtime Follow the Money members know we track this number very regularly. In fact, every week for our members here. They know that I use that indicator as something akin to like a temperature gauge, right? So as that number begins moving up towards 80% and beyond, I start to think a little differently, right? Just like when it goes down, down below 30% or so, I start thinking differently as well. So when that number gets above, say, about 80% or so, I start thinking about how I can lock in more of my gains, right? And we've already been doing some of that. In fact, we've been selling a little more than normal recently, especially as we are heading toward the month of September, which historically can be difficult for stocks. It's kind of a difficult month, as we know. Doesn't always have to be, but it often is. And if you go back and you look at the market between August and election day, August and say October, in midterm years, you do tend to see a drawdown in the market. So we are buckling up a little bit, expecting maybe some turbulence in the month of September, late August, for equities broadly speaking. Not because we don't have strong profits. We do. We have record profits. We've got a market that has been running higher, but the breadth is starting to become extended, right? So I'm perfectly comfortable taking some money off the table over the next few weeks, as I've been doing the last few weeks. I don't think the bull market is over. I'm not predicting a crash. I'm just simply doing what I think investors are supposed to do when the market gives them big gains, right? But either way, I'll keep our members updated on this indicator as it develops. If we begin moving deeper into that historically stretched zone, I'm probably going to get even more aggressive about taking profits. It's one of those fine balances where you respect the trend, but you don't get greedy. All right, let's move over to the U.S. dollar for a minute. The U.S. dollar index has been giving us some pretty interesting price action as well. We saw the dollar attempt to recover from its lows, and it repeatedly ran into resistance up into the 100 to 102 area. That was a key area that we were watching on the U.S. dollar. But recently, we saw the dollar slip down below that 100 level again, and that's why you've begun to see a little bit of a resurgence in not just stocks, but also in gold and silver and a few other commodities. A weaker dollar really provides a tailwind for commodities. And speaking of commodities, let's get into gold for a minute. Gold is also starting to wake up a little bit. It spent several months correcting and consolidating after that incredible rally. We saw gold get all the way up to $5,600 on the chart back in January. And then it came down, right? Came down pretty hard, came down to the $4,000 level, but that is where it really found key support. So gold recently has been battling around that $4,400 level, which has really been an important resistance level, but we're seeing it take off past that now, and it's testing its 200-day moving average right around the $4,500 level. So this is an area that I'd be watching closely here. A 200-day moving average breakout for gold would make all the sense in the world right now with all of the concerns about the debt and the bond market and all the things that are going on. Sure, you do have more opportunity costs whenever bond yields go up, but if bond yields come back down, which we're starting to see here with the Treasury move, we'll see if that lasts. Well, that could be bullish for gold. And gold looks like it likes today's announcements because it's been breaking out from that 4,400 level where it had been stuck for a bit. Let's see if gold can get back above its 200-day moving average. If it does, that's going to be good. And as I mentioned to our members, I started getting more bullish again on gold in Q3 after, of course, we've been bullish on gold for a long time. But for a period, especially after that January blow off top, we expected some consolidation and some general price weakness for a period of time. Nothing goes straight up forever. Also, if you're watching gold, watch that 100-day simple moving average. That is a key area, played a very important role during this advance that we've seen in gold prices. So we're watching that. Obviously, we have a huge long-term backdrop for bullish price action in things like gold. We have an enormous government debt. We got these persistent fiscal deficits and plenty of geopolitical instability. And we have central banks that are still accumulating gold. So anyway, obviously we're watching that. I think we should expect to see gold looking up toward that larger resistance level of about 5,000. I can see us getting back to that area by year's end. Maybe not all the way up there, but I think we'll be moving that way as we move into the end of the year. Now, by the way, copper also making some noise lately. It recently hit an all-time high, and I think, I continue to think that copper has one of the most interesting long-term supply-demand stories in the commodity space. Everything that we're trying to build right now, AI data centers, new electric grids, renewable energy, electric vehicles, all the things we're seeing with robotics, all of this stuff obviously requires a tremendous amount of electricity, and tremendous amounts of electricity require tremendous amounts of copper, right? So I continue to like this secular copper story as we go out, especially out to 2035 or so. There's just going to be a persistent deficit in copper based upon the current trajectory. So the world wants to electrify almost everything, and copper is one of the most basic materials required to do it. And we've talked about this on previous podcast episodes. We talked about how AI is a huge, investment theme, and we've been obviously riding that theme. But, everybody likes to talk about the chips, but they don't get as excited when they think about the transformers and the substations and all this other stuff, all the physical stuff that goes into building out AI. And you can't have an AI economy without the physical infrastructure underneath it. And that's one of the big bullish cases for commodities, particularly things like copper. Now, I also want to talk about oil briefly. Oil prices still remain relatively elevated, right? We have West Texas Intermediate oil, that's U.S. oil, around $86, $87 right now. We have Brent oil also around $92 as we speak, as I'm looking at the charts. So that's still happening in the background of everything we're talking about. The U.S. also has continued drawing down the Strategic Petroleum Reserve. The SPR is now sitting at its lowest level since 1982. That is a concerning fact, especially given the fact that we are up to our eyeballs in debt, and we're going to have to buy more oil, hopefully not at these prices, to restock that emergency stockpile. I mean, that was what the whole SPR was created as. It was created as an emergency stockpile. It's supposed to give the country, an additional cushion when we experience a major supply disruption. And so we've been using that cushion because of the war that's going on with the U.S. and Iran and Israel. And we've been using that cushion. And obviously releasing barrels from the reserve can help soften the effect of the current oil shock that we've been living through. But, those barrels don't just magically come back. You got to go replace them. You got to go buy them. And so at some point, the U.S. is going to have to go from being a seller of those barrels to actually being a buyer. So that's something to keep in mind as well. We just simply don't have the same emergency cushion today that we had several years ago. And don't forget, these higher oil prices feed straight back into inflation, right? They're going to cause prices to go up. They're going right back into consumer prices. So transportation and diesel prices in particular have really been difficult for truckers and other diesel-dependent machines. Also, airlines, jet fuel, which has actually come down a bit, but it's been pretty wild. Shipping and manufacturing, food, all of it. Oil works its way through virtually the entire economy, which makes the Federal Reserve's job even more complicated as it's trying to manage its dual mandate. Now, before we conclude, I want to talk also about Bitcoin and Ether. I want to take a quick look at the crypto space. Bitcoin and Ether have both had a fairly frustrating stretch. Now, I'm not particularly interested in trying to predict the exact day when either one of them is going to bottom. I do have a view on the larger cycle, though. Based upon Bitcoin's historical cycle behavior, I expect Bitcoin and Ether, for similar reasons, to begin strengthening as we move into the month of October. Now, history doesn't guarantee anything, of course. Every cycle can be different. The market structure is certainly different than it was last time. The regulatory environment is wildly different than what it was, 4 years ago. We have institutional investors involved today in a way that we did not have in the previous cycles. So I'm not treating October as some sort of magic date on the calendar, don't get me wrong, but seasonally and cyclically, I think we're approaching a very interesting period for Bitcoin and Ether. And if Bitcoin begins to regain momentum by breaking out, which we are seeing some today, as Bitcoin has gotten up to around $69,000, which is the highest level we've seen since late May, and it's testing its 200-day moving average. So that move is pretty big. I would expect that we could really begin to see that price rally into the end of the year and then well into next year. So that's what we are expecting. Right? We also expect Ether to participate as well. Ether is also strengthening as we speak. We have as I'm speaking now, a new 200-day moving average breakout on Ether. And that hasn't happened, by the way, since we lost it last fall in 2025. So we've been down below the 200-day on Ether for quite some time. And now we're seeing Ether strengthening. So as we head into September, October, I think all of our DCA activity into Bitcoin and ETH over the last many years, but also the last many months, is really going to begin to pay off. But at the same time, we got time. These are long-term holdings for us, so we're not in a big, huge rush. So let's step back. What are the markets telling us right now? Well, the S&P 500, which represents the broader U.S. stock market, remains very bullish, right? Corporate profit margins are at record highs. Market breadth is strong, but it's getting increasingly stretched, so we're watching that. We're taking a few more profits than usual in this environment as we head into September. Also, the stretch before the midterms tends to be a little bit funny in terms of price action. So you can often see some sell-offs. Not always, it doesn't always happen, but we're cognizant of that historical cycle. The U.S. dollar is struggling. Not only has it failed at the 100 level, it lost that key support level, but now it's actually below 99 as we speak. So we're seeing some, a big move there also in the price of the dollar, which explains the recent moves in other assets. Gold is beginning to improve technically, as we talked about. Copper is sitting at record highs, and I think there's plenty more upside for copper over the next decade. Oil remains elevated, and we have the Strategic Petroleum Reserve drawn down to levels we haven't seen, since 1982. It's almost 50 years or 45 years or whatever since we've seen that. And Bitcoin and Ether these really remain markets that I'm watching closely as we approach the end of the year. I think we're going to see a lot of good price action there. So I'm not bearish here, okay? But I'm also not interested in getting careless, right? There's a big difference between being bullish and being greedy. When the trend is strong, we respect it. But when the market gets stretched, we like to harvest some profits. So that's what we're doing right now, and that's what we continue to do for our Follow the Money members in the weeks ahead. I'll be providing plenty of updates to our members every day through our emails, every week through our webcasts, and also through our weekend updates. So all that for our members. If you're not a member, I strongly encourage you to check it out. If you're into investing and trading and you like to follow these markets and kind of follow along with our charting insights, just simply go to followthemoney.com/join. And there you can see our plans and pricing. I encourage you to come and join the community. We would love to have you. All right, when we come back, I'll have a final word and some concluding thoughts. Hold tight. All right, friends, welcome back to the final moments of today's broadcast. And before we go today, I want to leave you with one final thought. There is a temptation in times like these to become consumed with things that we cannot control, right? The national debt is one of those things. Washington and the Federal Reserve and the wars and the interest rates and the elections and the foreign governments. You can spend all day watching those things and worrying about those things and arguing about those things, and still be no better prepared financially when tomorrow arrives. And this is where I've learned over time that investors have to be careful. Fear can be deceiving. It can make you feel productive as an investor. It can make you feel like you're doing something, but worrying about the future is not a strategy, right? What you can control is much closer to home. You can control how much debt you have, right? You can control whether you have cash available when opportunities appear. That's in your control, right? You can control whether you're diversified. You can control whether you chase markets after they've already run like crazy, right? You can control whether you take some profits when the market gives them to you, right? You can control whether you're investing with a 5-day outlook or a 10-year outlook. You can control whether every headline gets permission to disturb your peace. And having lived through many of these crises myself and having invested through them, I'm thinking of the dot-com bubble, I'm thinking of the 2007-2008 crisis, I'm thinking of the 2020 COVID crisis and the 2022 meltdown in the stock market with rates. One of the great advantages an investor can develop over time is simply the ability to remain calm while everyone else is reacting emotionally. When you're calm, you can watch and prepare. You can make adjustments when the evidence calls for it. But if you're not careful, you can get locked into a cycle of worry where you wake up every morning searching for something to be worried about, right? I've seen investors destroy years of good work because they became convinced they had to predict what was coming next, right? So they'll sell everything because they think something's going to happen. And then the crisis doesn't happen. The market runs higher. And then the investor who sold at lower prices now buys them back at a much higher price, right? And then right about that time, what happens? Well, then the market tends to finally correct, right? That's wild, emotional price chasing, right? It's not investing. And I don't want that for you. There's always going to be another problem coming down the road, right? Always. There's always going to be another election. That's the most important election in our whole lifetimes. There's always going to be another recession. There's going to be another war. There's probably going to be an illegal war, by the way that this country deals with wars. There's going to be another bubble. There's going to be another bear market. There's going to be another bull market. But remember, your job is not to create a portfolio that requires the world to behave perfectly for you, right? Your job is to build a financial life that can endure an imperfect world. What that means is you need to have some liquidity, right? You got to have some cash on hand. You've got to keep your leverage under control, not too much debt. You need to own quality, appreciating assets. And you should consider taking profits when appropriate and to keep adding to great long-term investments when prices are attractive. And perhaps most importantly, you need to give time a chance to work for you. And you certainly don't want to allow money to become the thing that determines whether you have peace, right? Money is useful. Building wealth and investing, all of that, that's useful. But none of it, quite frankly, is worth much if the pursuit of it leaves you anxious every day. By all means, build wealth, be wise and pay attention, but enjoy life while you're doing it, right? Spend time with the people that you love and be generous with what you have and stay grateful. Just some words of wisdom and something to think about. Well, friends, I want to thank you for joining me on today's episode. It's been a great honor to be here with you. Don't forget, if you want to learn more about us and our work, go to followthemoney.com. We have lots of podcast episodes, videos, and articles galore there for your educational purposes on trading and investing and real estate, stock market, crypto, lots of stuff. Tons of courses as well. Be sure to check it out. And remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right back here next time. Until then, God bless.
Information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussion on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.